name is Bret Jensen, founder of the Biotech Forum. Today I'd like to share with you some rules that I have learned over 25 years of biotech investing that will help you become a better biotech investor. I'm not going to talk about things that are going to help you identify winners in the biotech world. I'm going to talk about rules to find stocks to avoid. Because being a successful biotech investor is kind of like being a slugger in Major League Baseball. It's not so much the pitches you swing at, it's also a lot about what you don't swing at. This year in Major League Baseball, the phenomenal career of Aaron Judge took off. This was a guy who came up to the majors last year in August and did very little to forewarn us of what a huge year he would have in 2017. He started the campaign hitting 30 home runs before the All-Star break and then winning the home run derby. He batted over 300 during that time, and he was the Triple Crown leader going into the All-Star break. After the All-Star break, however, he went into an epic 6 to 8 weeks slump where he hit 152 and struck out more straight games than any player in Major League Baseball history. He recovered in September to hit over a dozen home runs and bat in 31 RBIs in September. So what changed for Mr. Judge? Simple. In his first half of the year before the All-Star break and in September, he only swung at 20% of pitches outside the strike zone that he missed. When he was in his 6 to 8 week slump, he moved that up to 40%. He was chasing a lot of pitches. When he quit chasing, his performance improved. The same can be said of biotech investing. So let me go ahead and give you 3 areas of the market I avoid like the plague. One is what I call the 10-year rule. And that is simply put that any company that has been public for 10 years and still has not got an approved product across the finish line probably never will. Take the case of Mankind. MNKD. If you want to go ahead and look it up on a long-term chart, you'll find this company has been public for almost 30 years. In that time, about the only thing it has produced is shareholder disappointment, capital raises, and a complete implosion of value. I've been asked about Mankind for the last 15 years. My response has always been the same. It has been an unwieldy disaster for all that have gone into it. My second rule is never to go ahead and invest in a hot IPO until it's been on the market for at least 18 months. Most public companies come out to market with a whole bunch of analyst hyperbole, and many 18 months later are selling for 30 to 50 cents on the dollar compared to where they debuted. However, once analysts have moved on to another area of the market or another stock and lockup expirations have gone ahead and expired for management, a lot of times these promising companies can be basically bought for 30 to 50 cents on the dollar, and they're farther down their development path. Avoiding these hot debuts when they happen will save you a lot of money in the end. Finally, there are hundreds of biotech companies listed on U.S. exchanges. Biotech is one of the most high beta parts of the market. There is no need to go ahead and increase the risk by looking at overseas based pharma companies, either in Canada or in Israel or other small markets, or in the pink sheets or in the gray market. Biotech will have plenty of risk as it is if you keep to the U.S. stocks that are subject to greater regulatory scrutiny, more analyst coverage, and in my mind, more management competence. So those are my 3 rules to go ahead and increase your biotech batting average. And if you employ them, I'm sure you will go ahead and hit much less landmines than you have in the past.